Hello, everybody, and welcome back. Today, my guest is Alan Siow. Alan is a portfolio manager in the fixed income team of 91. Welcome, Alan.
Pleasure to be here.
Alan, the Asian bond market has developed dramatically during the last 20 years in terms of size and structure. Where are the investment opportunities currently?
So the Asian bond markets have grown in line with the growth of the underlying Asian economies, especially as these economies have transitioned to stages of development that require large amounts of capital to further develop. So this is capital for things like infrastructure, for things like the development of utilities, but also to improve manufacturing and the supply of basic materials. So the story of the growth of the Asian bond markets is the story of the growth of Asia. So as we stand here today, some of these markets are more ready for investment than others. And I think the three most important ones are China, India, and Indonesia. China and India because they are the largest and the fastest growing, and Indonesia because within the ASEAN region, it is certainly one of the more attractively placed economies.
Hi there. Just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. COVID-19 has given policymakers a whole new set of fiscal measures. How does this influence the Asian bond market?
One of the ways that Asia is different to other regions in the world in terms of the response of these regions to COVID is first, Asia was first in, first out, which has meant that by and large, a lot of the economies were able to recover very quickly. Many of these economies did not have to roll out the stimulus and the easing that many other economies eventually had to do. But obviously, the story is not yet complete because as we speak today, we're seeing the emergence of new variants. And so the Asian economies are now facing these in a slightly different position. But because they didn't spend any of their bullets to begin with, there are still some meaningful reserves to draw on should the crisis continue. Most of the economies have benefited from the fact that because of their stage of development, they are less reliant on the consumption sectors than developed markets are. So closures and social distancing have had less of an economic impact. It's still a very difficult social thing to endure, the distancing. But in terms of economic impact, it's been less acute.
The Asian bond market is considered opaque by many international investors. So how do you deal as a portfolio manager with the information asymmetries in this market?
That's an excellent question. So there are a combination of things that we do. I think one thing that's very core to our process is that we are bottom up. So we try our best to learn about these companies by understanding them as businesses and making sure that the fundamentals of the business are very sound. The way that we do this, and perhaps different to some of our competitors, is that we use a global ruler. So when we decide whether a company is good or bad, we judge them on the basis of how they compare to their peers in other markets, including the developed markets. So we have a sector-based model, which means that the person that evaluates a bank looks at only banks, whereas the person that looks at a utility looks only at utilities, as opposed to a regional model where someone that is, looking at, let's say, Indonesia might have to choose between a company that does chemicals versus a company that manufactures. So, quite different. And we feel like the sector-based approach offers us the best lens with which to look at these companies. We then combine, the fundamental approach with strong access to these companies and management teams, as well as our experience. So our team is based from people that have long experience studying companies and looking at these markets. So we can see the history and the track record of these companies and are aware of how they have developed along with the market over time. So based on this, we know the companies with a good track record that have behaved well in the past and we can be skeptical of the new arrivals and make sure that they comply with global standards before we invest.
The discussion about inflation is back in the market. How big is the risk of returning inflation in Asia, and how do you position your portfolios against that risk?
So I think inflation is one of the risks that the market is extremely careful about at the moment. And the reason for that is that we're still in the very early stages of recovering from the pandemic. And the data that we are getting is comparing periods today where we are in recovery versus periods in the past when the global economy was very much on its knees. So these comparisons result in very favorable, I guess, conditions for the inflation number to look strong, because you're comparing a good period with a relatively weak period. But for inflation fears to really play out, we need for the inflation to be entrenched and for it to be structural. And I think it's still too early to tell, which is why markets struggle with this, because we're constantly trying to predict the future based on not enough data points. So for Asia, I would say that we are seeing some signs of inflation, particularly in the manufacturing and basic material sectors, which have seen the fastest rebound and have suffered the biggest contraction. So that effect is largest. Whereas on the consumer side, so in things like retail and food and beverage, that inflation is much less pronounced. So Asia, I think, like the rest of the world, if we recall, prior to COVID, the world was not one where, we were concerned about very strong growth or runaway growth. So given the very large shock, we don't think that the world has yet fully adjusted to that shock. And we are not worried, therefore, that, upon the end of COVID, we're suddenly at a world where we're suddenly looking at runaway growth, because that is not the world that we had before the pandemic. And it's hard to then, see how we get there so quickly, given the very visible and extensive scarring that we've had in economies.
So inflation and interest rates go hand in hand, and we have seen first interest rate hikes in the US. How likely are interest rate hikes in Asia after the end of the pandemic?
Interest rates, central banks in Asia in general have maintained quite a tight ship. So relative to the big three central banks, so Japan, Europe, and the US, a lot of the Asian economies, for their domestic economies, have been running relatively high interest rates in their domestic currencies. So against that backdrop, given the overall softening of the economy, particularly with the current waves, the new variants of COVID, we think that interest rates are likely to stay at current levels, or perhaps they have more downward pressure from here than upward pressure. So we think actually that interest rate risks are not high, also because we are not yet convinced that inflation is structural and here to stay.
How did the structure of your portfolio change during COVID-19 so far?
So as we are bottom-up investors, we select companies for our portfolio based on how we think they will perform through the cycle. And because the universe of fixed income is comprised of a different subset of companies than, say, equity portfolios, fixed income universes tend to be much less growth focused. A lot of our companies were very well positioned for a slowdown because they are defensive. So think of sectors like banks or utilities that continued to, their business was uninterrupted by COVID largely. As a result, we didn't really have to alter the portfolio significantly. We did not have a large exposure to very sensitive sectors like travel, so airlines or leisure, or a large exposure to retail. So thankfully, through the COVID experience, mostly what we were doing was buying what we felt were very good companies in response to a dislocation that we felt was unnecessary or unwarranted. And as a result of that, we were able to take advantage of COVID, mainly to buy good companies at better prices rather than having to restructure our portfolio meaningfully.
ESG and sustainable investing are currently emerging fast as investment topics in Asia. Where do sustainable bonds open up investment opportunities for you and your portfolio?
As specialists in emerging markets, ESG has always been at the core of our process because ESG risks are one of the key reasons why emerging market corporates have a premium, and Asia is a key part of the emerging markets. So I think Asia has embraced the idea of sustainability and ESG very quickly. Many of the leading economies, especially China, have adopted leadership positions in this area. For example, China's commitment to be net zero by 2060 as a large economy is now well understood. And so as these countries make this transition, then the key corporates that exist in these countries will have to adapt and go along. So as a team that has been focused on emerging markets, since our inception, we're very excited by this development, and we think it will give us opportunities to find good investments for our clients that can help the countries and corporates in this region adjust to the new sustainable world in an equitable way.
So this was Alan Siow from 91. Thank you very much, Alan, for being with us today and sharing your insights.
Thank you very much.